The biggest lie new traders believe is a simple one, and it sneaks up on them quietly. They are told, sometimes outright, sometimes by implication, that trading is about being right, that if they can just find the perfect setup, the perfect indicator, the perfect pattern on the chart, profits will follow naturally. I learned early that the market does not pay you for being clever. It pays you for being disciplined. Have you noticed how often a trader can be right on direction and still lose money? Prediction is cheap, discipline is rare. Anyone can point at a chart and tell you what they think will happen next. It costs nothing to have an opinion, and the market is full of them. What costs something is acting correctly when money is at risk. Have you noticed how confident predictions sound before a trade is placed? The market does not reward forecasts. It rewards preparation and restraint. A trader who predicts well but cannot control size, exits, or emotion will eventually give it all back. Discipline shows up in small, unglamorous moments, waiting for confirmation, honoring a stop, staying out when conditions aren't right. That is where most fail. Prediction feeds the ego. Discipline protects capital. One feels good, the other works. You don't need to know what the market will do tomorrow. You need to know what you will do if it doesn't do what you expect. The trader who survives plans for being wrong more carefully than he plans for being right, because the tape has a way of humbling anyone who relies on opinions instead of rules, and it does so quietly, trade by trade, until the difference becomes impossible to ignore, especially when discipline was optional and prediction was treated as skill instead of what it really is. Just another guess waiting to be tested by real money and real pressure in real time, without sympathy or explanation. While the market continues on its way, prediction is cheap, discipline is rare. Anyone can look at a chart and tell you where they think price is going. You hear it everywhere. Up here, down there, breakout coming, collapse next. Opinions flow freely because they cost nothing. But trading is not paid in opinions. It is paid in execution. Have you noticed how confident forecasts disappear the moment real money is on the line? The market doesn't reward the trader who guesses the future correctly once. It rewards the trader who behaves correctly over hundreds of trades. That is where discipline enters, and that is where most fall away. Discipline means waiting when there is nothing to do, even when boredom starts whispering excuses. It means taking a trade that fits your rules even when fear tells you to hesitate. It means walking away after a loss instead of trying to win back pride. Can you follow your plan when your emotions argue against it? New traders believe the hard part is analysis. It isn't. The hard part is restraint. A chart can be read in minutes, but self-control is learned over years. The market offers endless temptation, constant movement, constant noise, constant opportunity to act. Yet the successful trader learns that doing nothing is often the most profitable decision. How often does impatience sneak in disguised as opportunity? Discipline also means accepting uncertainty. Predictions promise comfort. Discipline accepts risk. You don't need to know what will happen next. You only need to know what you will do if it doesn't work. That is the difference between gambling and trading. One hopes, the other prepares. Most traders fail not because their ideas are wrong, but because they abandon them at the worst possible moment, bending rules when pressure rises, convincing themselves this time is different, telling themselves just one more exception won't matter, and the market quietly waits while they prove that prediction without discipline is nothing at all, because the tape does not respond to what you think, only to what you do, and it keeps testing the difference every single day. Trading is not about being right, it's about staying solvent. New traders come in thinking the goal is to win arguments with the market. They want proof they saw something first, that their analysis was sharp, that their call was correct. But the market doesn't keep score that way. It doesn't reward opinions, and it doesn't punish ignorance. It only reacts to risk. Have you ever noticed how being right can still cost you money? A trader can predict direction perfectly and still lose if position size is wrong or exits are ignored. Staying solvent means surviving mistakes, and mistakes are guaranteed. The market is uncertain by nature. Uncertainty is the illusion that ruins accounts. The trader who lasts is not the one with the best forecasts, but the one who knows how much he can lose before he ever thinks about what he might gain. Do you know your risk before you know your reward? Solvency comes from respect for capital, for probability, and for time. Capital is the trader's inventory. Once it's gone, the game is over. Yet beginners treat it casually, risking too much on a single idea, as if one trade should change everything. It never does. Trading is a series of decisions, not a single verdict. One loss doesn't matter, but unchecked losses compound quickly. How many traders blow up not from being wrong once, but from refusing to stop? Being right feeds the ego. Staying solvent feeds the account. The market will always offer another opportunity, but only if you're still standing. Learning when to step aside, when to cut exposure, when to admit uncertainty, this is the real craft. The trader who survives bad periods earns the right to participate in good ones, and that right is purchased with restraint, humility, and an understanding that preservation always comes before ambition, because once the account is damaged, every decision becomes harder, every emotion louder, every mistake more expensive, and the market has a way of pressing hardest on those who can least afford it. Losses are business expenses, not personal failures. That is something new traders struggle to accept because they bring their ego into every trade. They want each position to prove something about them. Their intelligence, their instincts, their potential. When a trade goes against them, it feels like judgment, but the market is not judging you. It is simply moving. Have you ever noticed how price keeps going, no matter how offended you feel? Every serious business has costs. A store pays rent. A factory pays for materials. A trader pays with losses. They are unavoidable, and they are necessary. The mistake beginners make is trying to avoid losses entirely, as if a perfect record were possible. In doing so, they turn small losses into large ones, holding and hoping, refusing to accept the expense. Can you see how denial becomes more expensive than the loss itself? A controlled loss is not a sign of weakness. It is proof of professionalism. It means you recognize that the conditions you expected did not appear, and you exited before damage was done. That takes discipline. The trader who survives understands that one trade means nothing by itself. What matters is the series. One expense does not ruin a business, but ignoring expenses eventually does. How many traders treat losses as emergencies instead of routine costs? When losses are taken personally, emotions take over. Fear tightens stops too early. Anger increases position size. Pride refuses to exit. This is how accounts are slowly blurred. The calm trader accepts the loss, records it, and moves on without drama. There is no revenge trading, no need to make it back immediately. The market will be open tomorrow. Will your capital be there with you? The goal is not to avoid losing trades, but to manage them so they never control you. Once a trader understands that losses are simply the price paid to stay in the game, decisions become clearer, risk becomes measurable, and patience replaces desperation, because when losses are accepted as part of the process, they lose their power to shake confidence, distort judgment, or force action that does not belong in a well-run trading operation. The chart doesn't beat traders, their behavior does. Most traders blame the market when things go wrong. They blame false breakouts, manipulation, news, or bad luck. But the chart is only a record of price. It shows what happened, not what should have happened. The damage is done in the trader's response to it. Have you noticed how the same chart produces different results for different people? Price moves up and down without intention. It is neutral. What turns movement into profit or loss is behavior. Entries taken too early, exits delayed too long, size increased at the wrong moment. The chart never forces a trader to chase. It never demands overconfidence after a win or hesitation after a loss. Those decisions come from within. The market offers opportunity, but behavior decides the outcome. Do you react to price, or do you respond to it? Many traders study patterns but ignore themselves. They can spot support and resistance, yet fail to recognize fear and greed when they appear. The chart is consistent. Human behavior is not. That inconsistency is where losses are born. A plan works only if it is followed, and most plans fail not on paper, but in execution. How often does a trader abandon rules the moment pressure rises? Behavior also shows up in timing. Entering because of excitement, exiting because of discomfort, trading because of boredom. None of these signals appear on a chart. Yet they control results more than any indicator. The disciplined trader waits for confirmation and acts without emotion. The undisciplined trader acts first and explains later. If charts were the problem, everyone using the same setup would have the same results. They don't. The difference is patience, risk control, and self-awareness. The market is an honest mirror. It reflects habits without mercy. And until a trader learns to manage himself as carefully as he studies price, the chart will continue to look unpredictable, hostile, and unfair. Not because it is, but because behavior keeps interfering at the exact moments when clarity is required. Waiting is a position, whether traders admit it or not. New traders feel compelled to be involved at all times, as if money is made only when a trade is open. They sit in front of the screen and mistake movement for opportunity. But the market does not offer good trades on demand. It offers them in its own time. Have you noticed how the best setups often appear after long stretches of nothing? Waiting requires confidence. It means trusting your rules enough to do nothing when conditions are not right. That is uncomfortable for most people. Doing nothing feels unproductive, especially when price is moving and others are talking. But entering without an edge is not activity. It is exposure. The trader who waits protects capital by default. Do you recognize when patience is saving you money, even if it doesn't feel like it? Many losses come not from bad analysis, but from trades that never needed to exist. Boredom pushes traders into marginal setups. Fear of missing out creates urgency where none belongs. Waiting filters out these mistakes. It keeps the trader aligned with probability instead of emotion. A missed trade hurts the ego. A bad trade hurts the account. Which one matters more? Professional traders spend far more time watching than trading. They know that the market cycles between opportunity and noise. Most of what happens on a chart is noise. Waiting allows clarity to form. It lets structure develop. It gives confirmation time to appear. Rushing only blurs the picture. Waiting also sharpens discipline. It teaches restraint, observation, and timing. The trader who learns to wait is harder to shake out and slower to make errors. Over time, patience becomes an edge in itself. The market eventually rewards those who can sit through uncertainty without forcing decisions. Because when the right moment arrives, the trader who waited is calm, prepared, and fully capable of acting without hesitation, while those who were busy trading every flicker are already distracted, depleted, and emotionally involved in positions that never deserved their attention. The tape rewards those who listen, not argue. Price is the final word in the market, and it speaks clearly to anyone willing to hear it. New traders spend too much time trying to prove their opinions right. They argue with the tape by holding losing positions, adding when they should be exiting, insisting the market will come back to their level. But the tape never explains itself. Have you noticed how it keeps moving whether you agree with it or not? Listening to the tape means accepting what price is doing now, not what you think it should do. When price weakens, you don't defend it. When it strengthens, you don't doubt it. You respond. Arguing is emotional. Listening is professional. One drains capital, the other preserves it. The trader who listens adjusts quickly. He respects stops, reads momentum, and steps aside when conditions change. He doesn't need to be right. He needs to be aligned. The tape offers constant feedback, but only to those who are quiet enough to receive it. Being early is the same as being wrong. New traders take pride in calling tops and bottoms as if timing a move before it starts proves skill. But the market does not reward anticipation. It rewards confirmation. Acting too soon ties up capital and patience while price does nothing or moves against you. Have you noticed how often early turns into stuck? An early entry carries all the risk with none of the proof. You are exposed before the market has agreed with your idea. That forces hope to replace discipline. Stops feel wider, exits feel harder, and doubt creeps in before the move ever begins. Waiting for confirmation may cost a few points, but it saves far more in stress and mistakes. The professional waits for the market to show its hand. He doesn't need the exact bottom or top. He needs alignment. Once price confirms direction, risk becomes defined and behavior becomes calm. Being late by design is safer than being early by ego. Consistency comes from habits, not hot streaks. New traders get excited by short bursts of success and mistake them for skill. A few winning trades create confidence, but confidence without structure fades quickly. The market does not care about yesterday's gains. It only responds to today's decisions. Have you noticed how fast a hot streak can disappear? Real consistency is built quietly. It comes from repeating the same process regardless of outcome. Same risk, same rules, same patience. A trader who relies on streaks trades emotionally, pressing after wins and hesitating after losses. Habits remove that swing. They create stability when results fluctuate. Good habits protect capital during slow periods and prevent overconfidence during strong ones. They keep decision-making boring, and boring is often profitable. The trader who survives understands that consistency is not about constant winning, but about behaving the same way in every market condition. The market reveals character under pressure. Anyone can trade well when things are going smoothly. The real test comes when trades fail, when drawdowns appear, when patience is stretched. Pressure exposes habits that were always there. Have you noticed how your behavior changes after a loss? Under stress, some traders rush. Others freeze. Some break rules they swore to follow. The market doesn't create these reactions, it uncovers them. Price movement applies pressure and character responds. That response determines long-term results more than any setup. A disciplined trader stays steady. He reduces size, follows stops, and accepts uncertainty without panic. An undisciplined one seeks relief through action, mistaking movement for control. Over time, the market becomes a mirror, reflecting emotional weaknesses and strengths with equal clarity. Good analysis fails without emotional control. A trader can read charts perfectly and still lose money if emotions interfere at the wrong moment. Fear exits winners too early. Greed holds losers too long. The plan may be sound, but behavior overrides it. Have you noticed how emotions appear strongest when decisions matter most? Analysis happens in calm moments. Execution happens under pressure. That is where most systems break down. When price moves fast or losses appear, logic gives way to instinct. Without control, even the best setup becomes meaningless. Emotional control does not mean ignoring feelings. It means acting according to rules despite them. The trader who masters this can survive volatility and inconsistency. Without it, analysis becomes just another excuse to trade without discipline. Prediction is cheap, discipline is rare. Anyone can point at a chart and tell you what they think will happen next. It costs nothing to have an opinion, and the market is full of them. What costs something is acting correctly when money is at risk. Have you noticed how confident predictions sound before a trade is placed? The market does not reward forecasts. It rewards preparation and restraint. A trader who predicts well but cannot control size, exits, or emotion will eventually give it all back. Discipline shows up in small, unglamorous moments. Waiting for confirmation, honoring a stop, staying out when conditions aren't right. That is where most fail. Prediction feeds the ego. Discipline protects capital. One feels good, the other works. You don't need to know what the market will do tomorrow. You need to know what you will do. If it doesn't do what you expect, the trader who survives plans for being wrong more carefully than he plans for being right, because the tape has a way of humbling anyone who relies on opinions instead of rules, and it does so quietly, trade by trade, until the difference becomes impossible to ignore, especially when discipline was optional and prediction was treated as skill. Traders lose more from boredom than from bad setups. When nothing is happening, impatience creeps in. The screen is moving, candles are forming, and the mind looks for action. Boredom disguises itself as opportunity. Have you noticed how many trades happen simply because waiting feels uncomfortable? Bad setups are easy to blame, but boredom-driven trades are harder to admit. They don't come from analysis, they come from restlessness. A trader enters without a clear reason, manages without conviction, and exits with regret. The trade never had an edge, only an excuse. Professional traders respect quiet markets. They know that forced trades drain capital and focus. Doing nothing keeps risk at zero and clarity intact. Boredom tests discipline more than volatility ever will, because it tempts traders to create problems when the market hasn't offered any. Risk ignored always returns with interest. The market allows mistakes, but it never forgives neglect. A trader can be wrong and still survive, but a trader who ignores risk eventually pays more than expected. Small positions feel harmless, wide stops feel flexible, and losses are postponed instead of taken. Have you noticed how risk feels smallest right before it becomes dangerous? Ignoring risk creates false comfort. The trade stays open, hope replaces planning, and exposure grows quietly. When price finally moves against you, the damage is no longer manageable. What could have been a small expense becomes a serious wound to the account. Risk management is not defensive thinking, it is survival thinking. Defining risk in advance keeps decisions rational when pressure rises. The trader who respects risk stays in control, while the one who ignores it eventually learns that the market always collects what it is owed, with added cost for delay and denial. The big move comes after most give up watching. Markets spend more time doing nothing than doing something. Long periods of consolidation wear traders down. Attention fades, confidence weakens, and patience runs out. That is when opportunity quietly builds. Have you noticed how the best moves often start when interest is lowest? Most traders leave too early. They grow tired of waiting and look elsewhere, or they force trades just to feel involved. By the time the move begins, they are distracted or already positioned poorly. The trader who stays attentive without acting unnecessarily is prepared when momentum finally appears. Big moves require time to form. They shake out the impatient and reward the steady. Those who remain focused through quiet phases see structure develop clearly, while others only notice the move once it is already underway. The market teaches slowly, but charges daily. Lessons in trading are repeated until they are learned. The same mistakes show up again and again, overtrading, ignoring risk, chasing moves, each time with a small cost attached. Have you noticed how minor errors seem harmless at first? The market does not demand perfection. It demands respect. When a trader ignores a lesson, the price is small at first. Over time, those costs add up. What begins as manageable losses turns into consistent drawdowns. The lesson doesn't change, only the size of the bill. Learning in trading is cumulative. The trader who pays attention adapts early. The one who resists understanding pays longer. The market is patient, but it is persistent, and it keeps collecting until behavior changes. The market teaches slowly, but charges daily. Lessons in trading are repeated until they are learned. The same mistakes show up again and again. Overtrading, ignoring risk, chasing moves, each time with a small cost attached. Have you noticed how minor errors seem harmless at first? The market does not demand perfection. It demands respect. When a trader ignores a lesson, the price is small at first. Over time, those costs add up. What begins as manageable losses turns into consistent drawdowns. The lesson doesn't change, only the size of the bill. Learning in trading is cumulative. The trader who pays attention adapts early. The one who resists understanding pays longer. The market is patient, but it is persistent, and it keeps collecting until behavior changes. The market pays patience, not intelligence. A sharp mind can analyze charts, build strategies, and explain every move, yet still fail to make money. Intelligence seeks answers. The market rewards waiting. Have you noticed how often smart traders overcomplicate simple price action? Patience keeps a trader aligned with timing. It prevents early entries, forced trades, and emotional exits. Without patience, intelligence turns into interference. The trader starts anticipating instead of observing, acting instead of confirming. Being clever feels productive, but it often leads to unnecessary risk. The patient trader lets price come to him. He waits for structure to form and risk to define itself. Over time, patience becomes a filter that removes bad trades before they ever happen. Intelligence may find opportunity, but patience decides whether it is worth taking. Overtrading is a confession of impatience. It shows up when a trader feels the need to always be involved, as if sitting out means falling behind. The screen is active, price is moving, and the urge to participate becomes stronger than the plan. Have you noticed how trades multiply when patience runs thin? Overtrading usually has little to do with opportunity. It comes from boredom, fear of missing out, or the need to recover losses quickly. Each extra trade increases exposure and lowers focus. Quality gives way to quantity, and mistakes begin to stack. A disciplined trader understands that fewer trades often produce better results. Capital is preserved by selectivity. Every trade should earn its place. When overtrading stops, clarity returns, risk decreases, and decisions become intentional instead of reactive. Small losses are the trader's insurance policy. They protect the account from damage that cannot be repaired. A trader who accepts small losses stays flexible. One who avoids them becomes trapped. Have you noticed how refusing a small loss often leads to a much larger one? A small loss keeps emotions contained. It prevents hope from replacing discipline. When losses are controlled, confidence remains intact and decisions stay clear. The trader can re-enter later without emotional baggage. Insurance is never exciting, but it is essential. Small losses also preserve opportunity. Capital that is protected can be deployed when conditions improve. The trader who cuts losses early stays in the game long enough to benefit from favorable markets, while the one who ignores them slowly loses freedom of choice and control. Most money is made by sitting, not clicking. New traders believe profit comes from constant action. They watch every tick and feel compelled to respond. But trading rewards those who wait for meaningful movement, not those who react to noise. Have you noticed how profits often come after long periods of inactivity? Sitting requires trust in the process. It means staying with a position while the market does its work, resisting the urge to interfere. Constant clicking introduces doubt and mistakes. Each unnecessary action increases risk without increasing edge. The trader who learns to sit understands that timing is more important than frequency. One well-managed trade can matter more than 10 rushed ones. Stillness keeps decisions clear and capital protected, allowing the market to deliver results in its own time. Indicators don't replace judgment. Many traders search for certainty in tools, stacking indicators until the chart feels safe. But indicators only reflect past price. They cannot think, adapt, or understand context. Judgment is what decides when information matters. Have you noticed how the same indicator gives different results in different market conditions? Relying too heavily on indicators creates hesitation, signals conflict, decisions slow down, and responsibility is shifted away from the trader. When a trade fails, the blame goes to the tool instead of the process. That prevents growth. Judgment comes from experience, watching price, managing risk, and understanding behavior. Indicators can support decisions, but they cannot make them. A trader must interpret, not obey.